Welcome to the Big Mike Fun Podcast, where you learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlotnik. It is my pleasure and privilege to welcome Garry Pinkerton, who is a wealth strategist with Paradigm Life, but he also had a previous life. He was a submarine captain. It is incredible to have him here. Garry, thank you for coming on the podcast. Welcome.
Thanks, Mike. I truly appreciate it. This is a pleasure for me. I'm looking forward to it.
Thank you again for coming. It's incredible to meet a live submarine, strategic, submarine captain. So the first question, did you command a boomer or a hunter?
No, I was on a nuclear attack submarine. USS Tucson is one of the last of the Los Angeles class, the class that we built. And it's still going to be for many years the majority of all the submarines we have. We started building those in the 1970s and finished building them after 2000, I think, or real close to 2000. And then we built a few of the Seawolf class, and now we're building Virginias that are, we're trying to replace the Los Angeles class, but those are going away a couple of years because we built them so fast in the Cold War. So mine was pretty new. I had actually just come out of an overhaul, but yeah, I have been on a strategic missile submarine as an engineer officer, my second submarine tour, but the other three were attack submarines and commanded the Tucson and Pearl.
Got it. This should be a lot of fun. I've read a lot of books. I like Tom Clancy, and I've read virtually every single book that he's got out, and I just love how during the days of the Cold War, you were looking for the Russian boomers. I'm sure just tracking them and getting ready to shoot them down if they do something funny.
Yeah, so I joined right near the end of that event. The wall had already come down in Berlin, and but we still, every once in a while are using the same tactics that we used during the Cold War. But a lot of my mentors and a lot of people that I've looked up to and learned from were deep Cold War veterans that spent extra couple of months at sea than they planned on because the activity got hot and they had to go answer the call. So we certainly have unpredictable schedules on attack submarines even today, but they're not always chasing Russians around under the ice.
Yeah, thank God that whole thing calmed down. So
right.
And I was able to get out of the former Soviet Union as a result of the Gorbachev coming to power and kind of breaking the walls in essence.
Yeah, so that was certainly a personal experience for you.
Yeah, for sure. So tell me, how was the transition when you left the Navy? How, I know you're a very successful real estate investor, you're a wealth strategist, you have phenomenal success in real estate and investing. How do you transition from the military to the world of private life and investing?
Yeah, so I'll tell you, great question. And it really gets to the core of what has happened to me over the last 5 to 8 years. I was leaving command in 2011, and I knew that, it had been rough on my family, my command tour, but everything leading up to it as well. I mean, the nuclear power Navy has been, successful and incident-free for 65 plus years, and that doesn't come without a cost. It's a lot of work and a lot of long hours. But it's extremely successful because of that. And, we had a good run. We were over 20 years in the submarine force at that point, or right around 20 years. And it had been really good for us. It had been very successful. My command tour was really successful, and everything that I could have, dreamed of. But I also knew that for my family's existence to continue, I was going to need to find a different work-life balance. And so I knew I was on my way out of the military. I wasn't going to be going back to sea or commanding a squadron. And I was just trying to figure out how to do that. And so really, I got super excited after reading Robert Kiyosaki's stuff. I've always been interested in rental real estate or just real estate in general. And I got excited, and I wanted to move money that had been through plenty of roller coaster rides of the 2000 crash, the 2008 crash. I wanted to get it somewhere where I felt like I'd have more control and would be able to get some actual passive income that would replace my working income. So it was solely focused on real estate investing. And in 2011, I bought my first property. Like most things, that didn't go perfectly, but now soon I have 17. We're almost at 19. We'll be at 19 later this year. That's and basically I've used all of our loans because I have one on our primary residence as well. And I didn't really see this wealth strategist stuff with Paradigm Life coming into the picture. But when I was in escrow, when I was in contract for that first property and waiting on it to be, the construction to be finished, I came across Pat Donahoe and Paradigm Life and this idea of the infinite banking concept. And we at Paradigm Life refer to it as a wealth maximization account. But essentially, it's this concept of taking your banking into your own hands and using a whole life insurance policy as a way to efficiently grow, protect, and get some, tax-free, tax-efficient growth on your money, while at the same time leveraging those dollars for whatever you want. And I leveraged them to purchase my real estate. And I've done that with every property I've ever owned over the last 7 years now. And it made such a difference that about 4 years ago, I was talking to Pat Donahoe, a mentor and incredible friend of mine. And he said, I was complaining because what I'd done, Mike, is I went to this job conference for military members in Washington, D.C., and everyone there was different than me. They were all saying, when asked what they wanted, they all said, hey, I just want to replace the part of my income from the military that I'm losing. It doesn't matter where I live, what I'm doing, any of that. What matters to me is that we retain the comfortability that we have become accustomed to in our family. And for Sue and me, it was different. We were willing to take a little bit of a pay cut to do something that was inspiring for us. And so I was totally different than those people. And I was talking to Patrick that I want to do personal finance, but living here near New York City, not too many people want to talk to me about insurance-based traditional personal finance. They want to talk to me about Wall Street. And he said, well, you know what? Timing's perfect. He's like, I need some help. So I started working with Patrick remotely as an agent, doing what inspired me so much as a client. So the guests can't see me, but I'm a little bit hair challenged. And so I make the joke about being, the hair club for men thing. I'm not just a client. I'm also an owner. Or I think I got that back. I'm not just an owner. I'm also the client.
That's hilarious.
So hopefully that kind of gets you there. But I had no inclination in 2011 that I was going to become a life insurance agent, a wealth strategist working in personal finance. But I can't tell you how incredible this journey has been. It's been amazing for my family. My wife, Sue, is helping me a little bit with this. She's taken over our real estate as a real estate professional now. My kids are both young entrepreneurs. Loving it. Absolutely loving it.
Gary, that's great to hear. Thank you for sharing that. That was very interesting. So going to the basics, could you talk a little bit about life insurance as a self-banking vehicle?
Sure.
Just basics for my audience. How does it work? So what do? You basically buy life insurance policy with a high variable rider to build up the cash. Explain a little bit of how the product works basically, and how is that cash available as a loan against life insurance, and that's the availability of it's your own bank that you can borrow from when you need to invest in real estate or do whatever else.
Yeah, exactly. We did a great job with it, Mike. And so if we go back to before 1913, I promise this history lesson won't be long, but before 1913, there was no taxes in the U.S., right? And people in America would store all of their personal wealth in life insurance. And so if you think about a permanent life insurance policy, it's a pretty simple product where the insurance companies collect, then protect and grow a little bit, not a huge growth rate, the money that's inside. And along the way, starting in like the 1930s or so, they enabled the policyholders to actually get access to this cash that they're growing up if they need to. But you can withdraw your own cash that's in there if you want to, but that kind of makes you go backwards in growing this wealth. Generally, what people will do is they will borrow money from the insurance company, pledging their own as collateral. So if you have $100,000 cash inside a policy, then you can go to the insurance company and say, hey, I'd like to borrow $100,000 of your dollars. And the rate is pretty comparable to what you're earning inside your policy, but you're earning compounded returns and tax-free in that policy. From the insurance company, you're just paying an amortized, simple interest loan. Totally open-ended, though. You determine when and if you pay back the interest and principal on that loan from them. So it's a collateralized with cash kind of loan from the insurance company. And you can actually go to commercial banks and pledge your insurance policy as collateral for a loan, comparable loan from them as well. Sometimes you can get better rates from them, but generally my clients are just using the insurance company as their lending source. So, a couple of key things there is that a permanent life insurance policy is this product where the insurance companies are collecting, protecting, and growing dollars. So there are dollars inside it. In 1913, when the tax code came around, the IRS exempted, or Congress exempted, life insurance from that taxation. And then in the 1980s, they further clarified and they said, okay, not everyone is, and we're going to stop things that, like some very wealthy Americans from permanently taking their family's money outside the tax code forever. Because what they were doing is storing it in the life insurance. A person would pass away, that's a tax-free death benefit, and they would take all that money and very intelligently put it back into more tax-free life insurance, right? So in the 1980s, the Congress said, okay, we're going to limit this a little bit. So you have this rider, it's paid up additional rider, but it's a high cash value rider that you can attach on top of the main policy. You still get to retain the benefits, but you get to pump a lot more cash into it. And we have some companies that will let us do, like 10 times as much cash in the first year as you can put into the base portion, the main part of that life insurance. So it becomes very focused on cash, not so focused on the insurance side. And then so your money grows in there at 4, maybe 5% tax free while you have full access to it throughout your life. And so from a real estate investor or somebody who's note buying or, just investing in a temporary fund, it's a perfect fit to be able to, kind of have your cake and eat it too.
Got it. I appreciate the clarification. Somehow I was thinking you borrow from your own policy, but you clarified it that you would borrow from the insurance company. And what rates? I guess comparable to what your money is earning, 4.5% in that range?
Yeah, 4.5% to 5% is where they are. They float up and down they haven't changed in a decade, but they theoretically will go up when the returns in policy are going up.
Are they connected to the Fed monetary policy?
They're connected to.
Are they linked to LIBOR? Are they linked to?
Yeah, it's a long-term bond index, the Wilshire, I want to say, but it's a long-term bond index.
Got it. Yeah. So it gives you all the flexibility of, as if you could withdraw your own money, but you're not withdrawing. You're not incurring tax liabilities. You're just borrowing, and the interest that you pay to them, is that interest deductible? In other words, if you borrow, let's just, for the sake of a example, say you put in $250,000 into a life insurance policy, and I think there are options. We talked about this. You could do one-time big big contribution, I guess, up front, or you can do multiple, like a 20-year pay.
Right.
Just for the sake of a discussion, you put in $250,000 to start with. And from the get-go, maybe you have access to $200,000. I don't know the exact numbers, but I'm just rough.
Yeah, that's good. That works.
So you go to the insurance company and you say, I'd like to take $200,000 as a loan against secured by the policy. And they know you one day everybody dies, death and taxes. That's the only guarantees, right? And say they give you the loan and it has 5% rate, and then you want to invest that in real estate. So the question is, the interest that you're paying to the life insurance company, is that going to be deductible, or is it a personal loan that may or may not be tax deductible?
Yeah, so that really is I guess it's technically a gray area. I don't think it is. I mean, I certainly deduct mine. It really depends on what your CPA says, I guess, and what you and your CPA are comfortable with. The reason that some CPAs will say no is because, and this really comes from a company called the Guardian. It's one of the major mutual insurance companies, and there was a change that came out in, I want to say it was like 2004 or 5, where the IRS put something into the code to say that a loophole that is now closed also for home equity lines of credit. They were trying to show that my understanding is that they were trying to show that this did not apply for personal loans from life insurance policies. And if you're familiar, until 2018, the first $100,000 borrowed against your personal residence for any purpose, even to go on vacation, was you could deduct that interest. And then after that, you couldn't anymore. But that
the recent taxes completely closed any interest on a line of credit totally.
Right.
Yeah.
So that was going to be allowed back in the mid 2000s, but they didn't want to have the same thing happening with personal loans from life insurance policies. And
Got it. Okay.
put some kind of language in there that essentially said, in general, the policy loans against your own life from your own life insurance policy are not tax deductible. Well, a couple things. One, in the scenario we do this with whole life insurance, you're not actually borrowing your money; you're borrowing from the insurance company. The second, more important thing is that it's about, most CPAs, Tom Wheelwright and many others will tell you that it's not about where the money came from that matters, about whether it's tax deductible. It's about what you're using it for. So, I mean, they could put in the tax code, a loan from Grandpa Tom is not deductible. Okay, true. But a loan for the purpose of investment, interest paid on loans for the purposes of conducting an investment are tax deductible, regardless.
In general, that's right. That's right. So if you're borrowing for the investment purposes and you're paying interest on that is deductible. Yeah.
Right. So every CPA that I've had in my decade here of doing this has said, yes, if you're going to borrow against this to go on vacation, you shouldn't deduct that. If you're going to borrow against this to purchase properties or into an investment fund, it's absolutely deductible.
Got it. Okay. Thank you for that explanation.
Uh-huh.
So let's talk a little bit about lump sum investment versus like a 20-year pay. I bought for my wife. Well, my wife bought life insurance policy, just to be precise. She bought a whole life, and she bought something different from the self-banking. She bought more of they call it retirement package. It's a 20-year pay where we contribute fixed amount for 20 years, and then it sits there until she reaches age 65, and then she can withdraw for 10 years. Good amount of money, sort of as a retirement income. I guess it's a loan.
Mm-hmm.
So how is that different versus self-banking? I guess you design these policies differently for kind of retirement benefit versus self-banking?
So the only real difference there would be kind of how they're optimized for when the cash will be available. So the ones that we design have a lot more early cash value. There's actual policies that are titled high early cash value policies. That's not what we're doing here. But the one that your wife created for, with a goal of accessing the cash 20 years down the road, that is going to be optimized a little differently. It's going to be a lot more of a base insurance policy. I call it the base policy.
That's right.
It's not going to have as much of this high cash value paid up additions early in the policy life. I create them for a banking system so that you have access to the money early. Like your wife's policy, I'm guessing there's very little access to any of the cash in the first
few years. First 5 years is limited. That's right.
Right. So when I'm working with an investor, they're looking for, hey, okay, Gary, I get the benefits here, but if you're going to tell me I don't have any access for 2 or 3 years or 5 years, then it's just a non-starter. This is an active period of time where I'm investing, so I need access. So I will set these up so that there is somewhere between 70 and 90% of the money immediately available on day one. And the way we do that is that we reposition it to put a majority of the money into that paid up additions or into the cash portion of the policy. So I tell everyone in a very basic way of thinking of this, if you were building your own bank on the street corner in your local hometown, the base portion is what's going to get the brick and mortar put up and the vaults inside it. And then the cash portion or the paid up additions is where you back up the Brinks truck and stick the cash in it so that you can use that stuff immediately. It's a very kind of basic way to look at it. So we focus on high cash value early. But your original question was, hey, what about this lump sum versus ongoing contributions? Well, it turns out that limit that IRS put on in the 1980s to kind of keep the wealthy in America from putting too much into these at once, that limit means that you can dump cash into it, but you can't get excessive with it. And so as a result, there still needs to be this ongoing kind of base portion for, I tell people, you should consider 7 to 10 years of an annual ongoing savings to this. Then you can get away with stuffing quite a bit in the first couple of years and having it immediately accessible. But if you just put one lump sum in and don't ever contribute again, then you end up with either not having access to quite a bit of it, or it's what's called a MEC, a modified endowment contract, which means you don't get any of the tax benefits or many of the tax benefits. So I work with clients, push the funding up front. I still like to have them planning to contribute for 7 to 10 years, but it's flexible. We can adjust that if they want to go shorter.
Understood. Thank you for the clarification. Yeah, I've heard of the that max situation where the life insurance just loses all the tax benefits, and it's this is where your expertise is critically important to come in and help people to do smart things, not to do dumb things, just throw in the money and then.
Yeah.
Yeah, and what you do, my 2 cents comment, by designing the policies where the cash rider is high and then the base is low, actually cuts your commission. I know this because the policy my wife purchased does provide a pretty high commission to the insurance broker. And I have to say, I guess we made a mistake not buying the policy from you, but buying it from my insurance broker. I think he's a good guy. I am not saying anything at all. If he's listening to this, he's not going to get upset, hopefully. I've worked with him for a long time. It's just a different design. But the fact that you do it to benefit the clients, to give them self-banking focus rather than thinking a little bit more about the commission is very important. I mean, I think that's a great consideration, that your product is lower commission for you, but more valuable to your investors, clients who buy it for self-banking purposes rather than, insurance policies just in general.
Yeah. And it opens the doors to a lot of different clients that way, right? A lot of real estate investors for one. But so I know it's a silly phrase about, hey, we're losing money on each product, but we're going to make it up in volume. but you don't have to worry so much about, like, our goal at Paradigm Life. I'm very inspired by what Patrick's doing, and I left the military to come join him, is to try to get people back to the traditional personal financial foundation. And that comes from having some passive income. It comes from having, that bottom layer of Maslow's pyramid covered, that protection layer, right? So have the life insurance, have the car insurance, have the health insurance, have that stuff kind of in there as protection, and have an efficient way to grow your capital, which is the same product. It's the insurance policy acting as a bank. And then, with your help and with the help of others, teach people how to get some passive income coming. Then they're moving way higher on that old pyramid, and they're working on unique genius and their ability to add value to the world and a much better life for them and the family. So that's what inspires me. I don't so much worry about, squeezing everything I can out of the sponge of one individual. It just doesn't work well, right? So
yeah, for sure.
I come from the client perspective. I appreciated having all that liquidity. So it's certainly helping me out. Nice comment, though.
Yeah, thank you for the clarification. I didn't mean to imply that any agent would be driven by just the commission, but I just like the fact that you are helping folks build wealth, and you're helping folks build own self-bank, and complement that with passive investing. Because ultimately, Robert Kiyosaki and many other wealth strategists talk about, getting out of the rat race. You got to build enough passive income, and having the foundation is important. I didn't think for years I thought life insurance was a fee-heavy product, ridden with fees to benefit life insurance, and they paid high commissions. And the reason they paid high commissions because of the fees. And I thought a little bit about this, and I thought that doesn't sound right. But being a fund manager now, and we charge management fee, and I thought about the fees. The fees actually, they keep the lights on, and having quality product with fees doesn't mean it's a bad product. In fact, if the product is good and then they charge fees, it's only a fair deal. So as a fund manager, I just think of it as a way you get what you pay for, in essence. If you want a cheap product, you buy index funds with the lowest fees. If you want a product that invests in alternative investments, gives you flexibility, you look into life insurance, or you invest in alternative investment funds or real estate in general. Yeah. But of all asset classes, real estate is by far, we've been friends with real estate for a long time. It's most advantageous planned by the U.S. tax code. Even the latest, tax code changes where they are giving it a little bit less sort of tax deductibility. Real estate is still by far the best asset class.
Absolutely. And one of the things I wanted to comment is that just remember that this thing is more the savings account than the investment. So, it's that underlying place where you store your emergency reserves and your property reserves, but also your opportunity fund, getting ready for that next investment, whether it's real estate, or it could even be, the mutual funds and an index fund. If you wanted to do that, this is more about the foundation, not the actual investment. I try to back away from comparing this to other investments, not because it doesn't perform well. It actually often will outperform, the S&P when you think about the fees and the taxes and the negative market years. But it should be more compared to a savings or checking account that just grows really, really well.
Yeah, that pays 4.5-5% rate versus you put the savings account money and you look at the bank and it's the 0.25%. If you have $500,000 in the account, it's kind of crazy. It's how little the banks pay.
Pat calls it the and asset because of that it does all of that stuff. It's private, protected, liquid, growing at 4 to 5% and, tax free, and it's accessible to go, invest in Mike's opportunity funds.
Yeah, I greatly appreciate that. Just thinking of that the basic concept is a savings account is very powerful. Go find today 4.5% savings account. It doesn't exist. Nothing like this exists other than life insurance. So I greatly appreciate that. So we talked about the benefits. Any costs associated with life insurance? I mean, when people go invest into a whole life policy with you, with we have all these riders and self-banking, are they paying any high cost up front, or the cost to get paid if suddenly they don't pay premiums and then this thing gets canceled? I think there's a risk. People need to be at least aware that it's a life insurance, and if they buy a 20 pay policy, they got to make the 20 years contributions, right?
Yeah. So what I end up doing is really stretching out the payments as long as I'm able to do it with the insurance company. So similar to 30-year mortgage, instead of paying everything off in 5 years on a property, I want to stretch it out because I see that mortgage as an asset, and I want to have as little money as possible stuck in the principal. So the same way with the life insurance, I'll make that base portion, that main insurance policy, stretch out as far as I can. It doesn't mean there's not options to have it self-fund a few years down the road, or to pay it off early if you want to. You can certainly do those things. But it's better to design it initially to be more efficient so that more money is available on the cash side of things. As far as costs, it's really what I roll all this up, the commissions, the underwriting costs, the medical that you have to get done ahead of time. I call all that stuff the startup costs, and it is tied to the first couple years of the base portion of that policy, which is, again, why I make that base portion as small as possible. It indexes down, the amount that goes towards any cost. So generally, these policies are at a break-even point, which means there's more in there than you contributed, around the 5 to 7 year point, depending on how you design it. Maybe it's as low as 4. So it's a little bit longer-term investment, or a longer-term plan strategy. But you're guaranteed to have substantially more money than you contributed, even by the 10-year point. So
got it.
As long as you take a longer-term look at it, it's absolutely to your benefit.
Understood. And actually, your design is somewhat safer for folks, because if I understand things correctly, with smaller base and bigger rider, in case life situation changes and folks can't contribute as much as they did in the previous years, their base is low, and they can always just contribute just the base, right? That's right.
I work really hard to make sure that it's achievable even in the bad times. But you've also got other options. Even if that falls through, you can borrow against cash value. You can reduce the size of it, along the way. So plenty of options to reduce or stop payments if you had to do that. But my goal is to work really hard, and looking closely at somebody's budget to make sure that we're not starting something that is unachievable.
Okay, that's great. That's a great comment. So what do you think because it's a long-term investment, what do you think about life insurance for kids? I've heard the concept. It's almost sickening. You're going to insure your kid, God forbid something happens. But starting early, life insurance is cheap. So starting early is a great way. Maybe you can even save for college and, for their retirement, if you think about it.
Yes.
So there's wealth building.
There's a really good book out there called The Secret Asset that I really like. It's not George Antoni. It's David D'Arcangelo. And he talks about this idea.
The Secret Asset. That's the name of the book.
Secret Asset, yeah. And he talks about multi-generational wealth. And what he's talking about is starting this process in your family where the grandparents purchase life insurance on the grandbabies when they're born, and then the next generation does the same thing. And so you have this insurance that's being purchased, large policies, on 1 or 2 year olds, right? It doesn't make a lot of sense. But if you go back to think about life insurance, it's insuring a known event. It's like the only time in your life you're going to pay money for something you absolutely know is going to happen. And the person's going to die. Hopefully this 1-year-old lasts for their entire lifetime. But that's exactly what the Rockefellers have been doing with the Rockefeller Foundation for 6 generations now. I mean, John D. Rockefeller created this foundation, and their family has not ran out of wealth where the Carnegies and the Vanderbilts and many others have. And the reason is because they've been able to operate their lives predominantly tax-free. And they do this by creating policies on the children or the grandchildren. And then by the time those people reach age 20, they've got this incredible personal banking system that's well-funded, that they can use to pay for their college. And they've from day one got this alternative source where they don't have to go to high-interest credit card debt or any other place, where they get behind and get into trouble. So I've personally used them. I've transitioned to, I stopped my 529 plans years ago, and I'm now building this for my kids' college. If they choose to go to college. If they don't choose to go to college, then they'll use it to purchase their first rental property or their first investment or start their business. It provides all kinds of flexibility once you've funded something for 10 or 15, 20 years for a child.
Yeah, that's a great idea. Thank you for the book.
Yeah.
I was going to ask, but one of the questions I asked, what book you recommend, and this is you just made the recommendation. Yeah. So thank you. If people wanted to learn a little bit more about Paradigm Life, how would they go about reaching out to you? And they should obviously reach out to you, because I think everything is personal. It's a relationship. Yeah. We have a relationship. Yeah. That's the most important thing. And I know Pat as well, and Pat is awesome. But if folks wanted to consider life insurance, self-banking as a way to invest conservative part of their portfolio as a savings account, how would they get a hold of you? How would they reach you? What's your email? Don't give them your cell phone number unless you want to. Get a phone call at 3 o'clock in the morning. I'd like that life insurance policy, please.
I'll take those calls. No, I tried to make that very simple. So my website is not too impressive quite yet, but the email is up and running. And you can go to Garry at GarryPinkerton.com. That's probably the easiest way. We have a lot of great resources at Paradigm Life, which is a company that Patrick Donahoe started, and I'm working with him, of course. And I'll point you in that direction, but easiest is probably just Garry at GarryPinkerton.com.
Thank you. I think that's great. I greatly appreciate that. And I have to say that we talked about this. I want to buy myself a self-banking policy in addition to my wife's policy, and I'm working on this, and I'm definitely committed to do this as soon as possible. Because I'm a big Mike, I'm a little bit big. I got to lose, a few pounds to.
Just got to turn you into Mike, huh?
Yeah, I don't know if I'm going to ever get into small Mike, but as soon as I do that, you have my commitment. I will actually lose a few pounds and get a policy. So I think it's a very powerful concept. I think people should consider this as a part of their diversification strategy. And it's not the only thing, but it's one of the. It's part of the portfolio. And I've talked to we've all done many investments with Jason Hartman and with many other folks in other outside of Jason's ecosystem. We've done investments in multifamily, single family houses, self-storage, love real estate, every single asset class. But what I like the most about what you do is once you set up the policy and it's up and running, that self-banking is available, and this is what you did yourself, is to invest in real estate. So you can actually take the money out, use that as a cash in the bank, and then you leverage that on top with Fannie Mae, Freddie Mac mortgages. So can you talk a little bit about that very powerful concept? So life insurance is your savings bank. You build up enough cash there. You find a property that you want to buy. Go to life insurance, you get the down payment funds, so you have no cash out of pocket. Effectively, your life insurance finances the down payment, and then the rest comes in the form of a Fannie and Freddie mortgage. Is that how it works?
Yeah, you nailed it. That's exactly how it works. So if you remember, way back to the late night television commercials with Robert Allen and No Money Down, right? The guy got famous with the concept of no money down, and people used to do that with Fannie Mae loans as well, borrowing the down payments. In 2008 and 2009, after that crisis and the new more stringent regulations came out, one of the things they put in place was that you can't borrow the down payment. But in this case, you can. It's really the only way. And the reason is because the Fannie Mae banks recognize that this is backed by 100% cash. and is in the strongest position it can be.
So it is permitted. If you go to the bank and you can't show 60-day season money in your bank account, but you could show life insurance loan, that is sufficient, right? That is acceptable.
That's right. Yep.
Oh, that's great.
Mm-hmm.
You know what's sort of interesting? No money down deals. They're coming around. I mean, we've been financing hard money for quite a while, and typically we ask for skin in the game. And I work with some top guys in CG Mastermind. CG stands for Collective Genius. And these guys are sharp guys. But they're buying now, interestingly enough, some of these guys are buying portfolios of great investment properties. They're buying them in the markets you don't hear about. I mean, it's Cleveland, Nebraska. They're coming with the deals that they pick up, 40, 50,000 a property that ran say 100 a month. It's just phenomenal. The cash flow is obscene. It's almost like 2% a month. And the opportunities are there. And the fact that they don't have to bring much money down enables these great buying. So I've talked to a couple of these guys, and I told them, listen, in order for me to do a 5-year loan, I'm not going to do it for any less than 15% rate. 15% rate.
Right, because you
I
have
literally had a conversation.
Yeah.
I said, it's not interesting enough for me. I make more in the hard money, but I'll consider if we do 15% rate. And they said they're open to the idea if their money down is minimal or no. And I know these guys, and there's so much power. People are willing to pay some crazy interest rates when they have strong cash flowing portfolios. Yeah, as long as it's low money down. And anyway, so but this is much better, right? You don't go get 15% rate. You get Fannie Mae, Freddie Mac at 5%, and you have massive upside on these properties. So
right. And the liquidity to get that money back out is very fast because you didn't put the money in the property to begin with, right? Not even the down payment. So
your return on capital is very high. Yeah.
That's right. Yeah.
I don't even know what it is. Well, theoretically, there's a cost, right? You put up a down payment, so you have a loan. You're still paying interest on the loan, but net is probably, return on equity is almost, infinity if you put no money out.
Exactly. Yep. Yeah. If you can find a positively cash flowing property that you can finance, or you can cover the loan from the Fannie Mae bank as well as the down payment loan, then that's an infinite return. You're right.
Yeah, that sounds good. I think we're running just about out of time. I appreciate your thoughts. Any other final comments? Any other kind of insight? Any message from the captain?
So, for me, obviously this had a huge impact on my life. I ended up changing my career path and going in a direction I never thought I would, because I got inspired by what putting tools in the hands of individuals can really do. I mean, if you have a stable foundation where you're not worried about living under an overpass, and you have some passive income to free up your time so that you don't have to travel to work every day and go through the grind of that, people do amazing things when they're given those kinds of opportunities. And so that's what inspires me, is to help people put in place something that they can do with what I did and what you've done, Mike, and that is work in the field that is our personal unique genius. And so this is one of the major tools that let you get there. And I'd love and be honored to work with anyone who feels that, this has spoken to them, this meeting of ours.
Thank you, Garry. So the message is be in your genius zone.
That's right.
Do what you're good at, and you will perform 10 times better.
Yes,
it's funny how a whole educational system teaches us to do all the 90% that are not necessarily fun, most productive. Even, I have 4 kids, and you have 2, right?
2, yeah.
They go through schooling, and they have them all these required subjects, and it broadens the education. But the reality is they never use any of that stuff in their life, and then they complain, why do I have to take this wonderful course? And ultimately, my 2 cents is manage for talent. I agree with you. So if somebody has a talent, don't have them take all these elective classes. They don't help anything. Yes, they're widen the education, but not everybody is the same. Not everybody needs the wide education. So if somebody's in that genius zone, help them be more successful there. So I agree 100%.
That's right. And so putting these passive sources and the protections in place, what you and I are doing, is what helps people get there, I think. So inspiring. Thanks for letting me share.
Thank you, Garry. Thank you kindly.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnik. Keep listening and keep investing Big Mike style. See you on the next episode.